So here we're going to talk about cash, equity, and debt. This is going to be the first section that we'll talk about here coming up in this last little module that we've got. So cash, equity, and debt. For this chapter, we'll talk about cash and cash equivalents, equity investments, debt investments, and then there's a few cash and investment type ratio analysis that we'll do at the end. So the first thing we got to understand is what is cash and what are cash equivalents. So in accounting, when we talk about cash, when we say the word cash, we don't just mean paper monies. We also mean any coins that you have, any checks that you've been paid with, any electronic fund transfers, any foreign currencies, anything like that, money orders. Those are all cash because we go to the bank and we could get that paper money for it pretty quickly. We also have what is called cash equivalents, and those are also included in cash in your balance sheet, and they are typically short-term investments that have maturity dates of no more than 3 months. So, we've always defined current in this class as 12 months or less. Well, these are like super current, right? These are 3 months or less. Typically, these are going to be things like U.S. Treasury bills, any money market funds that you have, certificates of deposit, those kinds of items are going to be considered cash equivalents. We will also see towards the end of this section when we talk about one of the ratios that we also include accounts receivable, but it's only for that ratio. So you typically do not consider AR as part of your cash equivalents. When you do see these listed out in your balance sheet, what you're typically going to see is right at the top. Since cash is your most liquid asset, it's going to be listed as cash, and then you'll have a line item for cash and cash equivalents for each different type of cash equivalent you have, and then you will have a total line for cash and cash equivalents. Okay, so just be on the lookout for that. So what we're going to talk about in this section is investing in either equity securities or debt securities. So the question is, why would you want to invest in other companies? And really, there's a lot of different reasons that you might. But the biggest ones that we're going to talk about are really earning income, right? So you're either going to receive dividend income if you're buying equity shares, or you might receive interest income if you're buying debt shares. You can also see gains based on the increase of the value of the investment. So if you buy equity shares, the appreciation of the stock value, that's going to get you an increase in a gain from that increase. You may also want to be temporarily investing cash. Anybody that knows anything about finance knows that you don't want to just let cash sit around. If it's just sitting around, it's not doing much for you except providing a safety net. So typically you may, that may be another reason that you invest, is to have your cash make some money for you. And then finally, you might want to build a strategic alliance with another company. You may want to increase your market share in a market. You may be trying to get over that hurdle of barrier to entry and enter a new industry. You may be trying to enter markets in new countries. There are a lot of reasons why you might do it. So the first type of security we're going to talk about is equity investment. This is purchasing stock or shares of ownership in a different company. Typically, when you do this, you are purchasing it for the dividend income or for the appreciation of the value of the stock. Okay. The second type we'll talk about is debt securities, and these are bonds, right? That's typically what it is. You are purchasing the debt of a company, and your expectation is that you will be receiving interest revenue for purchasing that debt. So with equity investments, here we're talking about us purchasing equity in another company. It's kind of the flip side of issuing our own stock, okay? So in this case, we're going to be buying ownership interest in another company. We're going to have shares of interest in another company. And depending on how much we buy, we're going to have differing levels of influence. Now, in this class, we're typically only going to talk about insignificant influence, but you do need to be aware that the others exist and how to define them. So if you purchase 0 to 20% of a company's stock, that's insignificant influence. You just don't have kind of a pool or the weight to throw around when it comes time to vote, when it comes time to make decisions about investing in anything like that, board members, whatever the case is. You just have an insignificant amount of influence. Typically, you are just doing this to receive dividend revenue. That gets accounted for in the income statement as a different type of revenue called dividend revenue. And we also account for it on the balance sheet as an investment, but we make a fair value adjustment to it each period. We'll talk about that later. Okay. If you own 20 to 50%, 21 to 50% really, of the company's stock, you have what we call significant influence. If you own 47% of GE, the decisions, the votes that you can throw around are significant. You can help them make decisions. You don't own the company, you don't run the company, but you have a significant amount of influence over the decisions the company makes. The third and final kind is controlling influence, and that's that 51 to 100% ownership of equity. When you own that much, nobody's voice matters as much as yours. If you have 57% of GE stocks, nobody can tell you what to do. You're the one making the decisions at that point, right? I mean, conceptually. This is just kind of what we talked about here. Again, just in some more words on a slide, just detailing the differences. And the reason we're only going to talk about insignificant is because there are different, each one of these levels gets accounted for differently in your financial statements. We are going to talk about just insignificant influence because we simply use fair value to account for it. So let's talk about recording the initial investment. Okay. Let's say that Nathan Sportswear purchases 1,000 shares of Canadian Falcons common stock for $30 per share on December 6th, 2024. All we're going to do here, okay, is we're going to record the investment as a new asset, $30,000. That's that 1,000 times 30. We paid cash for it, so we're going to decrease the cash asset. Net zero impact here on the accounting equation, right? Your journal entry looks like this: a debit to investments, which is a new asset. This is an increase, and a credit to cash, which is a decrease to that asset. This is the type of journal entry we've been doing pretty frequently all year long, so it shouldn't be anything new or shocking for you. Now, when you receive a dividend, when you get that dividend revenue, okay, when they pay you the cash for owning shares of their stock, that goes into your income statement as dividend revenue, and here's how we record it. So let's say that Nathan Sportswear is going to receive cash dividends from Canadian Falcon of 50 cents per share on December 15th. So we know we own 1,000 shares as Nathan's. We own 1,000 shares of that stock. They're paying us 50 cents for each share we own. So you take 1,000, multiply it times 50 cents, you get $500. Our dividend revenue is going to be $500. Here you can see we increase dividend revenue by 500. We increase cash by 500. The increase in revenue increases net income, which in turn increases your retained earnings. Again, this is just a cash revenue entry and transaction. We've just got a new type of revenue here. Okay. The one thing we got to talk about here that's a little tricky is what we call the unrealized holding loss or an unrealized holding gain. This is your impact on net income. Okay. So if you recall a minute ago, I said that we record these insignificant influences at fair value. So each year we're going to go in, or each period, I should say, we're going to go in and we're going to look to the market. We're going to say the stock that we purchased is now worth this according to the market. We're going to make a fair value adjustment. Fair value being what would a reasonable person pay for it on the market. Okay. When we do this, typically we're going to have to create either an unrealized holding loss if we see that the fair value is less than what we paid for it, or an unrealized holding gain if the fair value is now more than what we paid for it. Unrealized in accounting simply means that the loss has not been realized. There has not been any actual loss or realization of loss in the form of less cash received or the right to receive less cash. We are simply just saying, if we sold it now, these are so liquid, we could go in and sell them tomorrow morning, or we could sell them tonight before work closes, that this is the cash we would get for it. Okay. We only realize the loss when we actually sell the investment. Okay, that's when the loss is actually locked in. So once we sell that investment, that's when we realize it. And we'll take a look at examples of both of these. Okay, we record the unrealized holding loss, the unrealized holding gain in the current year's income statement when we calculate net income. Okay, even though it's unrealized, we report it as part of net income because it reflects the fact that most of these equity investments could be sold immediately. And any fair change value or any change in fair value is going to be realized in that cash loss or that cash gain, and that's when it's locked in, that's when it's realized. So let's look at one that's recording the fair value of the investment in the balance sheet. So at the end of the year, Canadian Falcon's current stock price has Canadian Falcon stock has a current price of $28. So recall, we paid or they paid, however you want to look at it, $30 per share for 1,000 shares. So if you think back to long-term assets, we took the proceeds, the cash that we got, we reduced it by the book value, and that gave us our gain or loss. We're doing the same thing here. How much cash would we get for a single share? Well, right now, $28. What do we have it recorded at on our books? $30. So you take the 28, you reduce it by 30, that gives you a negative $2 per share. That's your unrealized loss because this hasn't really happened yet. We're just recognizing in our net income that if we did sell these today, this is what we would suffer. We would give up the right to $2,000 worth of cash. Okay. So here we're going to increase the unrealized holding loss for net income. This is basically another type of expense. So the increase in the expense decreases the net income, which decreases retained earnings. And we see we are going to decrease the value of the asset as well. Okay. So this red box here is very useful. How did we calculate the 2,000? Well, we initially paid $30 per share for 1,000 shares, totaling 30,000. Those same shares are now only worth $28 per share. That's their fair value. So we take the 28 times 1,000, that's $28,000. What could we sell them for? $28,000. The proceeds, our current book value on our books is $30,000. So 28,000 minus 30,000 is negative 2,000, or an unrealized holding loss of $2,000. It's a holding loss because we're holding on to it. We're not selling them yet. This is how it would look in an income statement. You see up here, you got your sales revenue, then operating expenses and operating income. What this is telling us is that dividend revenue, unrealized holding losses, unrealized holding revenues, those are going to be part of your other revenues and expenses, gains and losses section. Okay. So let's talk about recording the sale of the investment at a loss. So Nathan Sportswear sells 100 shares of the 1,000 shares that they had for $24 per share on January 18th, 2025. Now recall, we've made a fair value adjustment for this at the end of December, and it said they were worth $2,800 per share. We just actually sold them for $24 per share. The calculation's the same. How many shares did we sell? 100. So 100 times 24, that's 2,400. That's your proceeds. What did we say those 100 shares were worth on our books? Well, $28 a piece, 28 times 100, that's $2,800. Okay. Take your proceeds, $2,400, less your book value, $2,800. That gives you a negative $400 loss. You increase the expenses and losses category, which decreases net income, which decreases retained earnings. Here we did get cash, so we're going to increase the cash by $2,400, but we're going to reduce the investment by the book value. Okay. Here we can see everything lines up. We have a negative 400 total decrease to assets and negative 400 decrease to retained earnings. Your equation balances, your debits equal your credits. Everything is good. So remember I said we can still record these at a gain as well. So let's say that we sold those 100 stock for $32 instead of $24. So remember, the value of our investment is $2,800. So we sold it. Proceeds of $3,200 less the book value, or the value of the investment on our books, of $2,800. We have a positive $400. That is a gain on the sale. So we are going to increase our revenues and gains, which increases net income, which increases retained earnings. Okay. Now we got $3,200 cash, and we're going to take the investment off our books at book value, at that fair value we had. So we see we have a positive $400, an increase to assets of $400, and an increase to retained earnings in the same amount. Okay. So when we, in the next video, we'll talk about debt investments, and we will be done with this section.